All right, we are now going to look at some actual numbers going into a high cash value life insurance policy and explain with numbers, some visuals, when can taxes occur. So again, core benefits of a cash value life insurance policy, if I do everything right. This is why so many people purchase this. Safe, liquid, tax-free, cash value specifically, if I do everything properly. Hence, topic of this video, taxes. So on the cash value, we're going to look at the payments, growth, accessing the money, and then touch on the MEC treatment as well, or MEC limits and what a MEC would imply. So let's look at an example here. We're going to start with a 35-year-old male funding a policy for a short period of time, 5 years at $50,000 per year. Now the first thing we want to look at is where is the money going? Payments. When I make a payment into a life insurance policy, where can my money go at the end of the day? Because I think life insurance policy, I think what? Premium. I make a premium payment, I get a life insurance, and then eventually cash value builds. The thing is, and this is where I have so much fun with this stuff, my money can go where at the end of the day? The premium component or the PUA component? Here we have an underlying premium of $5,000. With this particular company, that's as low as we could drive it. So with our payments going in, before we talk about the taxation, money can go where? Premium or the PUA component. If you want to maximize your cash value, that entails minimizing the premium to the absolute degree possible. So underlying base premium, $5,000. Okay, total payment, $50,000 per year. Initial cash value, just about $44,000. Break-even point is highlighted in yellow between years 4 and 5. Now, with all that said, payments. I've got a net payment of $50,000 per year going in. That is made with after-tax money, meaning I cannot deduct that payment. Not if I want to maintain access to the cash value all the way through. I don't have the ability to do it. So after-tax dollars. First year, I take a hit of about $6,000. So if I need access to that 50K right off the bat, the full 50K, this would not be a good option for me. I got to make sure that I can take that first year hit. Yes, we want to minimize it as much as possible. If in that first year percentage, if it's a large payment, can be higher. Typically, we can get the cash value with a high early cash value product around 95% or so. But traditional long-term products, we'll see right around 87, 88% like what we see here. But anyway, on the taxes, after-tax dollars. Now, next, growth. As the money grows, I'm paying in $50 per year. When do I start to experience growth on this product? Year 5. I have paid in a total of $250,000 over 5 years, and I have $253,000. Now, I have more money than what I paid in. I see a gain. Next year, I pay in 0, and it grows from 253 to 265, and it continues to compound over time. Along with the death benefit, I do cut that term rider after year 7, but aside from that, continues to grow. Now, as I examine this policy, the growth, what did we mention before in the last video? Tax deferred. So as the policy grows, I do not pay income tax or any tax on the money while it is growing over time. Okay, so we covered payments and growth. Those two are pretty straightforward. Accessing the money. Now I want to use it. How can I pull money from a life insurance policy? When I can withdraw, we touched on this in part 1. This MEC limit on this policy is $50,000. Here's a point I want to touch on here. If I take a policy withdrawal in the first 7 years of a policy, what's going to happen? My death benefit will decrease. If I take a withdrawal, this does not apply to loans at all, but if I take a policy withdrawal during the first 7 years, because I'm funding up to the MEC limit each year, that will trigger what is called a material change. my death benefit will drop, which will result in my MEC limit dropping. If my MEC limit is $50,000 and I've paid in $50,000 in the first year or any of those years, and then I take out a withdrawal, I'm going to trigger a MEC in most situations. If I overinflated that MEC limit, or if I did not fund up to the MEC limit, if I had some MEC space there, then there's a chance I will not trigger a MEC. But very important to be aware of this. It would be similar to removing some of the term rider or lowering the death benefit in the first several years or in the first 7 years. If I do that, I can run the risk of running into a MEC. Granted, this death benefit is increasing, so we've built in some flexibility there, but at the same time, got to be aware of that, mainly as an agent. Now, that is specifically with a policy withdrawal. So if I take out a withdrawal during the first 7 years, I could run into a MEC, which could result in taxes. Now, let's say it's after the first 7 years because I cut the term rider, I'm not paying anything into it. Let's say I want to take money out when I'm 65 years old. How much we got? About 830 grand. So when it comes to accessing the money, if we cash out, what's going to happen here? I've paid in how much? What's my cost basis? $250,000. I've got 830. What's the difference there? Yeah, that's significant, right? It's about, what, $600,000, a little bit less. The difference, if I just decide to cash it out, I have to deal with ordinary income tax on the gains. So this is actually what, about $580,000, the gain here, with no risk over time. So I mean, that's great. But I cash it out, that is taxed as ordinary income, assuming the policy is not a MEC, if I cash surrender the policy. If I withdraw $250,000, then immediately loan the remaining $580,000, that's going to likely lapse. If a policy lapses, the same thing occurs where anything that I have pulled out that I received as a policyholder above my cost basis will result in income tax. So I want to be aware of that. Very important here. Let's go back up. So those are with withdrawals. Now, when I can easily withdraw, I can withdraw up to my cost basis of $250,000, then begin to loan out the rest. A lot of times we see that in income strategies. Very easy to do. Let's talk about loans, though, and have some fun here. So with policy loans, we're going to look at a loan in action. I pull out $100,000. I can take out a loan really anytime I want. In this example, we take out the $100,000. Here's my loan balance. The cash value is the gauge, call it equity, that determines how much I can borrow from the policy. So I had this year, year 3, $141,000. I decided to take a loan of $100,000. There's my cash value. Equity, if I want to relate it to a line of credit, it decreases. Now, another thing I want to look at here, shrink this a little bit, there we go, is with a life insurance policy, if I take a loan, the company will continue to pay me dividends and interest on my entire bucket of money. So even though I pulled out $100,000, I'm still going to earn dividends on that money as if it were still in the policy. I know we talk about that a lot, so I'm not going to get into it in detail here. How that happens is over here. When you pull that $100,000 out, look at your death benefit. What happens? Without the loan, it was 2.173. With the loan, it's $2,073,000. Clean $100,000 reduction there. So the insurance company says, okay, if you're going to take out a policy loan, the cash value is the gauge that determines how much you can borrow. We, the company, are still going to pay you, the policyholder, a guaranteed rate and a dividend as if the money were still there. How we're going to do that is by collateralizing your death benefit. If I die with a loan outstanding on my policy, the company is on the hook for that much less. Now at the same time, they do charge loan interest as well. This example is 5%, and the loan interest goes to the insurance company. Always good to emphasize that. So I've got the cost here, what we're doing in this example, paying it back, paying the loan interest out of pocket each year. We did that for 2 years, and then began to chip away at the principal balance. Okay, so when it is repaid, here's what I want to look at. There's my cash value, there's my death benefit, and compare that with the example on the left. Everything is identical to exactly what it would have been as if we never touched it in the first place. And we pull all of these values directly from the illustrations from the company, from their direct software. So with loans, no lost opportunity cost on my money. With loans, no taxation as long as the policy is not a MEC, which we're going to touch on next. So the MEC limit on this policy, $50,000. That is exactly where we set it. We solved for the minimum death benefit possible. Death benefits a little bit higher, MEC limits a little bit higher, because in this case study, we actually looked at an example where they kept on feeding the policy at $50,000 per year for a long period of time. So we wanted to stress test the policy properly. So MEC limit, just about $50K, meaning I have the ability to pay up to $50,000 per year, but I'm not required to do so. My minimum premium is still $5,000. Now, if this policy became classified as a MEC, meaning A, I started with a death benefit too low and deliberately MEC'd it, B, I cut the term rider too early, prior to year 7, or C, the dividend rate came down and I didn't stress test the policy properly, the death benefit didn't appreciate fast enough, and then I've got an ill surprise where I run into a MEC down the road. We test for that kind of stuff up front, but that can happen sometimes. So, if a MEC occurs, let's assume, for the sake of simplicity here, year 10, I've got $318,000 in cash value. I've paid in how much? 50 over 5 years? $250K. Okay? What would happen if my policy becomes a MEC? The death benefit still paid out income tax free. I don't need to worry about the death benefit with a MEC. The growth on the policy, as this money continues to appreciate over time, if I'm just going to let it grow, still grows tax deferred. If I want to access money, and if I access it through a withdrawal or through a policy loan, I have to pay income tax, and in this case, because I'm under the age of 59 and a half, a 10% penalty tax. I don't want that. That ruins everything. And what would it be on? The gains only, not your cost basis, because remember, the payments were made with what? After-tax money. A MEC does not give one the ability to deduct their payments. Does not happen. So with these gains, I've paid in $250. I've got, we're going to round up, call it $320,000. That's $70K. If I want to pull any amount of money, I'm going to be taxed on the gains first, and then the cost basis is not taxable, but that's last. Taxed on the gains first. That's the main thing I wanted to touch on here. So if I pull any amount out, withdrawal or a policy loan, I've got to deal with income tax there. So we don't want a MEC, in short. No, this was a lot of information, more nitty-gritty stuff, talking about taxes. I know some people love tax talk, some people, they hate it. But hopefully you found it informative. If you have any questions, feel free to reach out anytime. We'd love to connect with you. And as always, I do hope this helps. Thanks. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.